welcome to this episode of PS Perspectives. My name is Chris Stegeman, and I'm joined by Colin Callahan. Colin, thank you for being here today.
Hello, Chris. Thanks for having me. Happy to be here.
Great. So just by way of background, Colin and I are both product specialists here at DoubleLine Capital. Colin's focus or specialization is in global developed credit, which would include investment grade corporate bonds here in the US, as well as high yield and bank loans. But today, for at least the next 5 minutes or so, we're going to really focus on the US high yield corporate bond market. And Colin, clearly it's been a very difficult year for fixed income. When looking at the AG, which is really the most widely used barometer or index of fixed income returns, it's down 16% year to date. That index was incepted in 1976. Down 16 would make it the worst start to a calendar year on record, which makes sense. We have decades high inflation levels, which has led central banks to try to combat said inflation with more hawkish central bank policy, which has of course led to higher yields as well. So with that as kind of a backdrop for fixed income and really wanting to focus on the high yield market, could you provide our viewers with an update on how high yield specifically has fared this year?
Yeah, thanks, Chris. So it has been a challenging year for fixed income on the whole, and high yield has participated to the downside. However, high yield bonds carry less duration than their investment grade counterparts. So although they might have more credit risk, the high yield bond index has a duration of 4 years, where the investment grade bond index has a duration of 7 years. And that difference of 3 years in a rising rate environment has helped high yield bonds outperform to the downside by about 5.5%. So down 14.5% year to date relative to investment grade bonds, which are down 20%.
Yeah, certainly down 14% is nothing to write home about for a fixed income investor, but I think it's a great point, right? We're not saying down 14 is good here. It's just notable that despite having higher credit risk, one can't forget about the rate component and the lower duration profile for high yield versus investment grade. So clearly it's been a pretty painful ride to get to these levels that we're at, but at least on a going forward basis, I know that here at DoubleLine, we certainly think it's a more opportunistic or a better opportunity set for fixed income investing as we move forward. So could you, for our viewers, just put into context what a high yield investor would be being compensated, whether it's in terms of spreads or yields at this point in time?
Sure. And if you look on the screen, you can see spreads on the high yield index are at 523 basis points. It's well above their long-term 10-year average of 420 basis points. And really, we've only been at these spread levels twice going back 10 years. In 2015 and 2016, during the energy crisis, we saw spreads blow out as energy prices rapidly declined, and energy makes up the largest sector weighting of the high yield index. And as well during the COVID-19 crisis, where spreads blew out rather quickly, and then we saw them come back in as the Fed intervened in the market. And DoubleLine, as an active fixed income manager, finds that 500 spread level to be notable as a more attractive entry point for high yield bonds.
Yeah, certainly, right? 500 is more attractive than 300 or 400, and spreads could continue to increase. We all know that. But we could talk about spreads, Colin, for hours, right? But let's talk about how does spread translate to all-in yield for a high-yield investor today?
Sure. I think yield is an important factor to note. And if you look on the screen, we're nearing a 10% yield on the high yield bond index. Going back to July of 2021, we're at about 3.5%. So we're more than double that today. And this has only happened twice in the last 10 years, again, during the energy crisis and during the COVID-19 sell-off.
Yeah, I mean, 10%, that's certainly a number. Maybe I'm dating us here, but we've both been in the industry about 10 years or so. And the last 10 years were an extremely low yield environment, more or less. You had mentioned the energy crisis of 2015, 16 and COVID, but those were pretty, especially with COVID, it was tough to take advantage of those yields. And as you said, the Fed intervention led to a pretty quick snapback in terms of spreads. I also would think within high yield, Colin, yes, 10% yield, very attractive, but also some room for price appreciation, right? I believe the high yield index is pricing at about 84, 85 right now, last I checked. And only a year ago, last summer, it was at 105. So that's also something to bear in mind. Which brings me to my last question. You mentioned we're at over 500 basis points of spread. How historically has a high yield investor done going, let's say, back 20 years if they had invested in high yield over 500 basis points?
Sure. And so DoubleLine, as an active fixed income manager, we're trying to identify credits that are going to give an end investor the best return per unit of risk. And our global developed credit team ran a study going back 20 years looking at the high yield bond index. And if an investor was willing to buy high yield at a spread level at 500 or above and hold for 2 years, their returns were positive 99% of the time. So obviously you can't time the market, but DoubleLine finds that 500 spread level on high yield to be a notable entry point for investors.
Yeah. Yeah, again, I think that's a very powerful number, 99% historically, at least going back 20 years. And of course, markets don't necessarily repeat, but they do rhyme. So again, Colin, thank you for being here today. I hope our viewers found this update on the U.S. high yield corporate bond market worth your time. Again, if you have any questions, as always, feel free to reach out to the DoubleLine team, or you can check out other subscriptions on our DoubleLine YouTube channel. Thanks again, and have a great day.